Hello and welcome to another episode of Darwin Investors. Today we're going to talk about how to kind of rescue a down position to see if even if it's worth rescuing. In my case, we're going to be talking about Nvidia. So Nvidia just released earnings this past Wednesday, and by all accounts, it was kind of like a perfect quarter. The stock should have gone up in price, but instead of going up, it went down in price. And I guess it could be expected, not really, but I guess it could because the Nasdaq as a whole went down 3% on that day, but Nvidia went down more than the index at large. And so I need to sit back and analyze whether or not this is a position that I want to stay in. Do I want to try and average down on it, or what the story is with Nvidia? And a lot of these principles will apply, like I said, to any stock. But in this case, for me, it's applying to Nvidia. So let me go ahead and share my screen and we'll get into this. So here are the options that you can have when you're getting into a down position. And some of these things get a little bit technical. I'll go ahead and do my best to try and explain it as we go along. I don't want to get too far in the weeds, but let's just say that these are the options you have with a down position, at least what I have anyway. You can sell all your shares and just admit defeat, that like I'm wrong about Nvidia. I should just sell it, cut my losses, and be done with it, right? So that's one option. That's what I did with PayPal. I looked around PayPal and I thought, am I right or wrong about PayPal? The price per earnings is good. All this stuff looks good. It's way down from last year. It should be a good time to get in on this. But then I started thinking about, well, when I go when I go to check out of something and it offers me PayPal or use my Visa, which one do I choose? Yeah, the same one you choose. I just go with my Visa card. It's easier. I don't need to sign up and make an account. Um, and so that Venmo I like, but then there's PayPal, so there's or Cash App, excuse me. There are different options with that. So there was just a lot of ways to process a payment. So at the end of the day, I thought, you know what, I'm wrong about PayPal. Let me just go ahead and get out of it. Thank goodness I did, because that was about $100 something ago. But am I wrong about Nvidia? Should I just get out of this now before it's sitting at $100? So that's something to consider. You always want to have enough humility with the stock market to think, well, maybe I'm wrong about this one. You never want to just lose all your money because you don't want to admit you're wrong. At the end of the day, do you want to be correct or do you want money? So I prefer to just have the money. I don't care. Okay, I'm wrong. Fine, market. You got me. So that is one thing that you can do. Secondly, you can bring down your cost basis. And what I mean by bringing down cost basis, this is something I'm going to try and explain. But through the use of options, you can bring down your cost basis. You can do that by selling covered calls. Some people call that selling short. You can sell short against your long position, also known as selling a covered call. Or you can create an additional long position by buying the option contract for a long position and then sell a covered call against that. When you do something like that, you generally want to sell your covered call shorter to expiration and buy your long option with a further out expiration. And for that, it's called a calendar spread. Or a diagonal spread is another term that they might use about it, because you're going to be buying something in the money and selling something further out of the money. This would be called a calendar debit spread. This requires a level 3 options account to do this. This is for an entirely different video, but I'm just saying that by doing this, you'll get control of 100 more shares that could kind of help you get out of a hole. I don't have level 3 options account. I don't ever need to do this. If I want the shares, I'll buy them. If I don't want the shares, I don't buy them. I have no need for a level 3 options account. So this is never an option that I will use, but it's something that, some people might choose to opt for, is to sell a poor man's covered call, or basically, what's called a calendar debit spread. But again, this is not an option I'm going to choose. You could buy put options as a hedge against your position. So that would be another option, is that you really like the position, you think it's going to continue going down, so you're going to buy options against that position. But here's a problem I have with buying options. Let me go here to trade options. Let's go with Nvidia. Is they're expensive. I guess it's worth it to some people. Remember, you want to buy them a little bit further out. Let's go with June. You want to buy them in the money, which this one is. So we would say that the break-even price of this is $245. This is a put that you can buy with a strike price of 245 that expires on June 17th. This thing will sell for $3,277 or $32.77 a share. So basically what we're saying is that to buy this, to break even, I have to make this price up. So by expiration on the way down, this thing needs to be $245 minus 32.77, or what does that work out to? $213.23 or something like that. And so this thing has to be below, say, 213 bucks for me to start making any money. That's a hedge against my position. But what if Nvidia announces something that goes up? I lose all of this money, and then I don't get the upward benefit of this. I don't get the benefit of this thing going up. Well, I don't want to limit my upside. To me, that's idiotic. So I will not be buying a put as a hedge. So the thing that I tend to do is I average down on my shares, or I sell a put at the same strike price where I would be averaging down. And so why would I do that? So I can average down if the price is at that price, I'll go ahead and buy it. But if it's not there, let's say it's at $205, I can sell a put against let's say it's close to where I want to average down to, but it's not quite there. I can sell a put at that strike price, which will say I will buy these if it goes to that, but only if it goes that or below. I'll buy it for 200 bucks. We'll say in this case, I'll buy it for 200 bucks. And so in this way, I'm going to collect premium while I wait for it to get to that price. And in that way, it can help me reduce my cost basis. So what I'm going to do now is I'm going to stop sharing my screen here. I'm going to go to show you what I mean by this. I have to basically hide account information. Let me go back and share my screen. So let's look at, say, AMD. Here's one that I'm currently working the trade with. So if I look at AMD and I look at my current month, we can see that my current cost basis is I have 100 shares, $103.97 per share. And that's because I bought them at 114, sold them at 119, bought them at 121, sold them at 128, and then bought it back at 116. Because I was doing a bunch of buying and selling, I was making money. You can always see that I sold it for more than I bought it for, right? And so for that reason, my cost basis is lower. I never once bought it for $103.97, but because I made money buying and selling it, my cost basis is $103.97. Now, if I include my options here, you can see that my cost basis is $100.07. So I made about $390 on options. So what did I do? I sold a put for $105 strike that expired on February 18th for $319. I ended up buying that back for $95. So I made some money there. Let me see, I did a couple more here. It looks like I sold another put for $114, bought it back for $18.65. And I sold another put with a $110 strike that expired yesterday for $88 and bought it back for $18.65. So you might say to yourself, well, what's the price of AMD right now? So is it over $110? Yeah, it is. It's about $113. I could have, well, why wouldn't I have just kept all 114 plus 88 plus 319.35? Well, the reason is because with options, you want to get in and get out. Once you make your money, just get out. These things can go south on you so fast. You've made money, just get out. The opposite of making money in the market is greed. You have to know what you own. You have to know when to get out. And knowing what you own is half of it. If I look at something like, say, a Palantir, now I knew what I owned. I knew it was, let me see, go all. I never traded options on, but let me see if I made any money on Palantir. Let me see here. Well, maybe this here a little easier. I made $3,900 on Palantir, getting in on November 20 and getting out on this day. So this is with all my options and everything. If I didn't include my options, which For some reason, it is. Oh, there we go. Yeah, I don't know. $3,889 on Palantir I made, and I ended up eventually selling out of them at like $24.20. And so why would I sell out of them? Why would I not just average down? Well, I knew what Palantir was. I still think it's overpriced at $10, but I'm not, it's not like I'm not willing to get into these stocks. I will get in these stocks. I will chase around these stocks like the truffle pig. I guess I am the truffle pig of Wall Street because I will sniff out this money and I will go after it. I will make Kathy Wood look like Warren Buffett, so I will go after it. What about Lucid? Did I make any money with these guys? Let me see. Um, Lucid made 4,200 bucks with those guys. What about Lending Club? Did I make any money with them? I think I'm just trying to come up with some off the top of my head I can think about. Let's see. Yeah, I made $3,600 with Lending Club. So these are all stocks that when they start going down, do I start thinking, do I want to average down this position? Well, I have to start thinking about what they are, who they sell to, and then kind of look at their financials and decide, is it the kind of company that I want to get more involved in? Is it the sort of thing I want to average down on? Is it the sort of thing I want to sell puts on? Or is it the sort of thing I just want to exit entirely? And in the cases of those three, I thought, after further analysis, it's time to get out of these positions. So what just happened with Nvidia? Well, Nvidia stocks drops after a record-breaking earnings. Analysts wonder, what more can you ask for? Like I said, it was a perfect quarter. There was no reason for that to go down in price, at least nothing that stood out immediately. But like I said, you always want to allow yourself the possibility that you could be wrong. Remember, stay humble. That's part of this. Do you want to be right or do you want to be broke? So you got to ask yourself these questions. And so in my case, I always want to allow myself the opportunity to change my mind, and that goes in life in general, as well as the stock market. So Nvidia reported double the profit it had from a year ago, broke new sales records, and provided a strong outlook amid supply chain concerns on Wednesday. In response, Bernstein analyst Stacy Rasgon titled his note, "What more can you ask for?" Well, that's true. What more could you ask for? I mean, Nvidia had everybody baffled. What about this guy here? Nvidia stocks. Even the experts are stunned. Nvidia stock crumbled on the back of outstanding fiscal quarter four results. Here's how Wall Street analysts try to square that circle. And so they go on saying they can't believe it, whatever. And it said, to reiterate, I'm about as baffled as the analysts cited above. Nvidia delivered near flawless results, and I don't think that investors should have expected much more. Based on this, I think that the post-earnings sell-off helps to widen the window of opportunity to buy Nvidia on the dip. I agree. So I did crunch the numbers. I'll let the cat out of the bag. I'll let you know that I do intend on keeping Nvidia. I do intend on averaging down, but the problem is, where do you start buying it? Exactly where, at what price is the price that I believe is a good price to start buying the dip. You don't just buy any dip. I didn't buy the dip on Palantir. And so you don't just look at it and say, well, this is less than what I paid for it now. Let's buy it here. So you have to do a little bit of due diligence. And that's what we'll go through. By the end, I'll show you where I'm going to be buying the dip on Nvidia and selling puts at that same exact strike price. And so Nvidia here, Nvidia posts strong Q4 results. And so just to let you know how strong their results were, Emily, we have a beat on the top and bottom line for Nvidia. They came in with $7.6 billion in revenue. That's above the $7.42 billion or $7.42 billion that analysts were expecting. They obviously have a $1.32 earnings per share, which was way ahead of expectations of $1.22 a share. They also beat on data center and gaming, their two biggest arms of revenue and net income. And probably more important than any of that is their guidance. So a lot of big news here. As far as the stock being down, I mean, they did beat on their Q1 estimates. They're seeing for Q1 roughly $8.1 billion. In Q1, $8.1 billion. Analysts were only expecting $7.2 billion. That's like a 12 or 13% beat just on guidance. So they beat on net income, they beat on revenue, they beat on guidance, and then their stock got clobbered. Why is that? Well, this guy might have something to say. He says that 2 days ago, Nvidia stock is a strong sell following the ARM deal collapse. So Ian Bezic seems to think that the ARM deal collapse is big enough to send this thing tumbling. And he gives us reasons. He says that they're not going to be able to generate as much revenue as they would have done ARM does business with a vast array of customers, including Apple, Qualcomm, Intel, and Huawei. And so he says that if they had gotten the rights to ARM, they could have sold all these licensing type of rights to these companies here. And he's not wrong there. He says that the valuation makes no sense. He says that the verdict is that Abhinav Davlari recently cut his price target for Nvidia stock from $194 to $187. And I can see where they're going to get these prices, and I'll show you in a little bit why they would get those prices when I break down the numbers. But just to let the cat out of the bag, it's basically through my numbers, it's based on a 30 price to earnings ratio forward. It's based on a 30 forward PE is basically what they're saying. They're saying with a 30 forward PE, the stock should be trading at 184, at least what I have, $184 with my numbers. And so, what is the ARM deal? Well, the ARM deal is the chip that goes in most of our phones. It's run on what's called a RISC. There are two types of chips: the RISC and the CISC. ARM is RISC. It's the reduced instruction set computer processor. It's the reason why on your phone you can expand and like contract pictures, and you're waiting for like things to fill in and stuff like that. It processes instructions much quicker. It's kind of a simpler way to process instructions. It doesn't do as many complex things, but what it does very, very quickly. And so that's what RISC is, and RISC is what ARM is, and the reason why it makes it ARM is really valuable is because it's in all of our phones, and everybody has to license it. So, what is the value of ARM? Well, ARM was valued at 25 to 35 billion. So they're basically banks are planning to pitch IPO valuations for ARM upwards of $50 billion. The people said ARM is likely worth between 25 to 35 billion based on the industry's valuation metrics. Well, that seems about right, as far as like what ARM is worth. Old Masayoshi Son here of SoftBank, uh, he was going to bring in $80 billion on this ARM deal from Nvidia. SoftBank paid $32 billion when it acquired the UK-based chip business in 2016. Mr. Son said the sale to Nvidia, under which SoftBank would have received both cash and Nvidia shares, could have been worth $80 billion because of a rise in Nvidia share price. So now Nvidia is going to be paying. ARM is worth 25 to 35 billion. Masayoshi Son bought it for 32 billion, and now Nvidia is going to pay 80 billion for it. I'm sorry, that's not a good deal, especially when you consider there's a big thing to consider here. They're saying that the according to Motley Fool, it seems the acquisition of ARM will not go through, but it isn't so bad for Nvidia, and so this I agree with. Back in 2020, it was announced that Nvidia would acquire ARM for $40 billion, but that's increased to $80 billion since 2020. Nvidia believes that the acquisition provides an opportunity to accelerate ARM and boost competition and innovation. While this might be true, regulators think otherwise. Yeah, but they're still going to have access to ARM, as we'll soon see. Yeah, nothing here really important, but the most important thing here is this, is that Nvidia falls as ARM deal collapses, but this NASDAQ stock is soaring Tuesday. Why would it go up? Why would the stock have gone up when the ARM deal falls through? Well, the reason that happened is that said the termination provisions of the agreement will still involve Nvidia and ARM having a relationship. ARM will retain the $1.25 billion that Nvidia prepaid under the agreement. In return, Nvidia will hold on to its 20-year license of ARM intellectual property. So instead of paying $80 billion or more than double what this company is worth for the right to use ARM and license ARM, they're going to only pay $1.25 billion for the right to use ARM. So now they have all their technology for the next 20 years and did not have to pay $80 billion for it. And so this is the reason why the stock popped. It's because this deal falling through was not bad for Nvidia. It was actually good for Nvidia. And what are they doing with this technology? So Nvidia says they're developing a full spectrum of ARM CPUs. Grace being the most, the one that's going to be coming out in the first half of 2023. The company says that its inaugural Grace CPU is on track to be released in the first half of 2023, but its release marks just the beginning of Nvidia's long CPU journey, Wang says. The company has a 20-year license for ARM's architecture, so it will use the instructions set to develop CPUs for a wide range of applications. And so basically they're going to be jamming all of these risk-based CPUs into all of these data centers, making that they're going to have the most incredible, fastest data centers that any company could ever hope for. But it also is good for autonomous driving, AI, machine learning. You name it. These chips are going to be the backbone of this industry. So all very exciting stuff. And then we see all the things that NVIDIA gets into. You can see how important this is going to be. But why would NVIDIA fall? Well, they would fall because it has everything to do with this price to earnings ratio. So here in FizViz, I did a stock screener of the technology stocks in the semiconductor industry. And you can see that NVIDIA here trades at a PE, at least at this time, of 72.99. I don't have a FinViz subscription, so this is delayed. Right now, they're currently trading at 61, but at the time this is 72. All that's pretty moot because the point is it's over 30. So it trades at a PE of 73. You can see that Qualcomm trades at 19, Intel trades at 9, Texas Instruments trades at 20, AMD trades at 44, but Marvell has no PE, so it's not profitable. NXPI trades at 27. So we would say that anything under 30 might be pretty fair for just a semiconductor company. And we're going to see in a second, is NVIDIA just a semiconductor company? Well, I don't think so, but stock market does. So what they think is correct. So they want NVIDIA in the same, at least in the same category as NXPI, or maybe on semiconductors. What are they trading at? 26. So yeah, 26, 27. That's kind of ideally where they'd like to see NVIDIA, because they don't see the same NVIDIA that I see. When I look at NVIDIA, I see this. So NVIDIA I see as a company that is got their hands in a lot of different instruments. They're not just a chip maker or a GPU maker, sort of like an AMD. Well, AMD is kind of expansive now that they bought Xilinx. Link in the description. I break that down as well. But they're not like Intel. They're not like Qualcomm. Qualcomm is a 5G player, 4G player, but they're so much more. To me, NVIDIA is an AI company. They're an AI company that happens to make GPUs and CPUs, and the best GPUs and CPUs in the market. And the distance between them and second best is only going to get wider and wider as they release more of these more advanced chips. But they're an AI company that happens to make the best GPUs and CPUs in the world. It's sort of like looking at Tesla. Is Tesla a car company? No, they're an AI company to me. They're an AI company that happens to make cars. It's like Amazon. Are they a retailer like Walmart, or are they a shipping company like UPS? I would say they're closer to a shipping company. Is Chick-fil-A a chicken company, or is it a customer service company? I would say it's a customer service company. And so these are you have to dig deeper to figure out what kind of company this is. And now Wall Street doesn't agree with me. They're saying all NVIDIA is a chip maker. Suck it up, sunshine. But I think they're a bit more. Why is that? Well, let's go ahead and look at some of the highlights. So they look at their gaming sector here. Gaming sector is their biggest sector, but only by a little right now over data center. One of the things they're doing right now that I think is really cool in their data center is they've got this thing called GeForce Now. And GeForce Now is a gaming studio, and it allows you to download games onto your computer. So instead of having like an Xbox or a Sony PlayStation, you get GeForce Now, and it gives you access to over 1,200 games. Games that they added this year would include Call of Duty Vanguard, God of War, and Rainbow Six Extraction. So they're a huge gaming player, and so obviously, if you're serious about gaming, you're going to want the best CPUs and GPUs there are. So you're gonna buy these things at any price pretty much, and then you're going to play the games that they give you to download it with. Now they're also, this is the part of their business that has me the most excited, is their data center business. And as soon as their data center business starts making more of their gaming business, you're going to see their stock price go right through the roof. That's my prediction. In their data center, they're big into AI. They basically they just entered an agreement with Facebook or Meta to do AI research using their Nvidia DGX systems, and this system's going to get a whole lot better with Grace and their new risk arm type of system. So I'm sure Meta's going to want their newer stuff. They're not going to want this one here, but they're going to be big into this AI research. They have partnerships with Microsoft Azure for their AI. Um, this I think is kind of cool. A team of Stanford researchers set a world record for fastest DNA sequencing of a human genome. So they're into like genome sequencing. They're into omniverse, metaverse with Facebook, AI in general, with Microsoft Azure. Um, Professional visualization. This would be again more omniverse stuff. They launched this Nvidia Omniverse for creators that basically allows individual creators to create their own little metaverses using open source 3D applications all on their own using the Nvidia platform. I think that's really, really cool. Um, University of Illinois Urbana-Champaign researchers built what is believed to be the longest, most complex 3D cell simulation using NVIDIA GPU accelerated software. So why do I invest in Nvidia? Well, I think that, if you start looking at some of these things, and the list is about to go on here, is that when I'm investing in Nvidia, I'm investing in Jensen Huang, and I think that Jensen Huang is the smartest person on earth. If you ever sit around and think who's the smartest person on earth, I think it's that guy. And so I'm basically putting my money into this guy's vision or this guy's technology. And what I'm reading here right now is be nothing compared to whatever it is they're going to come up at the end of fiscal year 23. This is the tip of the iceberg. And there's going to be so much more. They're right now into automotive and robotics. They formed a multi-year partnership with Jaguar Land Rover to jointly develop and deliver next generation automated driving systems. Plus AI-enabled services and experiences. They've also got the same agreements with Neo and Xpeng, and they have a robo-taxi fleet with this pony, never heard of it, using NVIDIA Drive Orin. So they're into deploying robotics applications using this Isaac autonomous mobile robot platform. So they're into autonomous driving, robotics. They've also got a part of their business which is dedicated to crypto mining software. They're into crypto mining. They're into Omniverse. They're into data centers. They're into gaming. Yeah, they're just a chip company. Get E&B, Zach, you ding dong. No, they're not. All right, so let's go ahead and look at their revenue here. So January 31st, 2021 to January 30th, 2022, the revenue went up about 60 something percent, from 16.67 billion to 26.9 billion. But what I think is really interesting is their income from operations went up. This was a 26%. Their income from operations on 16.6 billion was 4.5 billion. Their income from operations on 26.9 billion was 10 billion. So this is a 27% operating margin. This is a 37% operating margin. This tells me that they're not doing a lot of capex spending or capital expenditure spending. They've got a bunch of fixed costs that are staying fixed. So as the bigger that their revenue gets, the bigger that their profit gets, because they're not like Amazon that's consistently flushing money down the toilet. These guys are really good at doing what they do as far as like generating profit and AI technology and that sort of thing. The margins are important because that leads to net income. Net income is important because that leads to earnings per share. Earnings per share are important because that leads to their price to earnings ratio, which is sitting right over here at 61, which is what's giving everybody the freaking heartburn here. So what we got to do is figure out what's a fair price earnings per share that will give you a PE ratio. What I believe to be about 38 is probably fair forward PE for 23. They'll let a lot of these analysts and market folks take a, chill out and figure out what a fair price is for that. And for that, I think that price per earnings ratio that I think everybody can get their arms around, at least have a little bit of solace, is 38. So a forward PE of 38 in 2023 is what I'm seeking. They currently have an earnings per share of $3.85. As we said, they have pretty good operating margins. Their operating margin, not pretty good, it's actually really, really good. Their operating margin is 37%. This year. It was 27% next year, and I believe they can get it to 40% next year. Their guide for Q1, remember, was $8.1 billion. So if I multiply that by 4, plus add a little bit every single quarter as they guide upwards and upwards, and believe me, they also sandbag their stuff. I'm going to sandbag it too. I'm going to say they're at 34 billion, but I really believe it's going to be 35 billion. But for the purpose of this video, I'm just going to say it's going to be 34 billion. So this is where the problem is, though, folks. This is the reason why people are downgrading the stock and selling it even after blockbuster earnings. There's two things I was able to come up with, and here's one of them. They have a 26% revenue increase this year over last year. That's really super good, except for one problem. The revenue increase from 2021 to 2022 was 62% in that time. So they went from 62% revenue increase to only 26% revenue increase. Oh no, it looks like this stock is overvalued because they're not growing as fast as they once did. Okay, that's going to send off some red flags. And I agree, it does. Their net income was 36% of their revenue, so their operating margins was 36% of their revenue in 2022, and it was 26% in 2021. I expect that their revenue would go up, and I expect that their operating margins will go up in accordance. Just it'll go up together. And I'm saying that conservatively, I'm thinking 40%. So they're going to have a 40% operating margin in the fiscal year 2023. The number of shares that they had after dilution, I'm saying it's going to be 2.75 billion shares. You can see here that their diluted shares in 2021 was 2.15 billion. Their at the end of 2022 was 2.535 billion. At the end of the fourth quarter, for whatever reason, in 2022, it was 2.545 billion outstanding shares, and the year before it was in 3 months ended 2021, it was 2.524 billion shares. So between these 3 months ended here and the end of the year, they bought back 10 million shares. So they basically diluted 25 million shares over last fiscal year. I'm saying that they're going to dilute 40 million this year just to be on the safe side, to bring it to 2.75 million shares. So hopefully that wasn't too many numbers and too confusing. So the net income estimate for fiscal year 23 is 40% of what I believe will be their net income of 40% of what will be their revenue for 2023 works out to $13.6 billion. So again, their revenue, remember what I had right here, was going to be 34 billion, and their margin was 40%. So if you divide or multiply 34 billion by 0.4, you get 13.6 billion is what I expect their net income will be next year, is 13.6 billion. Remember, net income is important because that's how you determine the price per earnings ratio. The net income in fiscal year 2022 was 9.75 billion. That represented a 125% per year increase over the year prior. Well, that's outstanding. This year, I was saying is going to be 13.6 billion. That's only a 40% increase over the year prior. It's like, oh man, that's not as good as 125. So this has got analysts spooked. They're like, oh, whoa, they're only growing 40% this year. Oh, the roof is caving in. Well, that's good, folks. This is really, really good. But nevertheless, the problem's becoming more clear. And so I'm understanding now that the revenue is not growing at a rate that analysts like, and the net income is not growing at the rate that analysts like. So, or at least not what they've become accustomed to with respect to paying for Nvidia shares. So now we're saying that they're going to have 13.6 billion in net income. They're going to have 2.575 billion shares outstanding, which gives us $5.28 earnings per share. Now remember, this number is a little bit high. I could probably have done 2.55, and that would have probably been closer. But let's just say $5.28 earnings per share in fiscal year 23. If the goal is a 38 PE, that gives you a stock price of $200. Let me just show you real quick. So the current share price right now of Nvidia is, let's go ahead and look this up here. Nvidia share price. The current share price is $236.42. And this just show you just a real quick review how we get price to earnings ratios is you take the 236.42, you divide it by the earnings per share. It gives you, which is $3.84. And that gets you a price to earnings ratio right here of 61.49. So I want 38, right? So what number gives me a forward PE of 38 with a share price, earnings per share of $5.28? So I want 38, so it would be 38 times $5.28 gets me a share price of $200.64. And that's with the share price that, and I was being super, very, very conservative. Let's see what Schwab thinks they're going to earn next year. So they have a forward PE of 42.56. So that would be, let's see, this number divided by X would equal this. So 42.56. So it'd be just their share price divided by 42.56. So 236.42 divided by 42.56 equals $5.55. So I thought 528 and they think 555. And really I probably have more shares outstanding than I should have. So we're a little bit closer than I thought. So they think that the earnings per share next year is going to be 555. I put down 528, but either way, I want to be really conservative because I'm going to be putting down real money on this, and I'm going to be selling puts at that real price, and I'm really going to be buying shares at that price, and that price is $200. And before I let go, I do think it's like, I guess this would be bonus information here. I think this is really cool. So here's the way that their different industries broke down year on year by platform. You can see that their gaming platform made $7.75 billion in fiscal 21, and their gaming platform in fiscal 22 made $12.46 billion. That's up 61% year on year. Their data center went from 6.696 to 10.6. I have a feeling once all of their ARM technology gets into their chips and they're going off and they're getting like, oh, everybody's going to want their stuff. Trust me. I think that the data center is going to actually rise above gaming. When this happens, it's going to send their share price skyrocketing. You can see that the total of these two is about 23 billion. The total of everything is 26.9 billion. The lion's share comes from gaming and data center. In Omniverse, you can see that's up 100% year on year. Automotive is up 6%, and their crypto mining is up 84% year on year. So there you have it, folks. That's my plan for Nvidia. I'm going to go ahead and hold on the shares I have. I'm going to sell puts at $200 strike. I'm going to average down should they ever get down to $200. And I'm going to just hold on for the ride and just put my faith in Lord Jensen Huang. Please, if you got anything out of this, I know it was a long video, but if you got anything out of this, go ahead and like and subscribe and hit that little notification bell. And until then, we'll see you next time. Bye.